So, there's been some discussion recently of the possibility of imposing an unrealized capital gains tax on individuals that have more than $100 million in net worth. And, taxes are always a mixture of economics and philosophy, and that kind of stuff can be controversial. But in this video, I'm just going to look at the actual proposal and just talk about the feasibility and difficulties of such a system. Now, the language in this tax proposal comes from the U.S. Treasury's 2025 revenue proposal. And obviously, the Treasury is over the IRS. And so this document is one of the places where new taxes get discussed and proposed. And it's really important when you read this type of document to understand that it is not a neutral presentation. This is a partisan policy proposal, and there are going to be implicit opinions discussed in this document, as we'll see. Now, the section we are interested in starts on page 83, and that's titled, Impose a Minimum Income Tax on the Wealthiest Taxpayers. So in the first sentence, this section opens up with noting that long-term capital gains have a maximum tax rate of 20% plus an additional 3.8%, and that extra 3.8% comes from the net investment income tax, which applies to anybody who makes more than like a couple of $100,000 in a given year. And for long term, that has generally always been defined as a position that's been held for longer than a year. Now, next we have kind of the obvious, which is, again, historically, a capital gain was only taxable upon a realization event, such as the sale or disposition of an appreciated asset. Meaning, if you hold on to an asset and don't sell it, the gain has not been income because, well, you haven't actually gained anything yet. You have the same asset that you started with. And even though on paper it's worth more, you haven't actually received that money, nor have you received any assets that you didn't already have. And then the next line, as a result, the federal income taxation of the appreciation of an asset that accrues during an asset's holding period is deferred. Now, to me, that's a bit of a play on words because deferral kind of implies that the income has already been generated. But again, the traditional definition has been it's not income until it's actually realized. So again, this is where there is a bit of a bias in the terminology in this document, from my perspective, that they are kind of saying things the way they believe they are, but that doesn't actually reflect the way things have been traditionally viewed. Again, income traditionally means you got something that you didn't have before, whereas on an asset that you're holding, it hasn't changed what it is until you sell it and turn it into something else. So basically it says, for anybody with wealth, and that's basically going to be assets net of liabilities, anybody with wealth greater than 100 million, we want to impose a minimum tax of 25% on total income. But here's the kicker. We are now going to define unrealized capital gains as income. Now, one thing before we even get too far in here is this minimum tax of 25%. Number one, they've already noted above that traditionally long-term capital gains are only taxed at the highest level of 23.8%. Regular income is actually in a higher tax bracket than capital gains. So we see here on the IRS website that currently, if a person has income in excess of $578,126 in a given year, they're actually paying 37% on that income. Capital gains, again, are taxed at a lower rate. So it's interesting that their proposal says a minimum of 25% on everything. And it's not clear whether the capital gains are now going to be viewed as regular income, because it's actually possible that the taxation, if those things are counted as regular income, will actually be much larger than 25%, because we're talking about people that already have more than $100 million in net worth. And once you call all those gains income, well, does that kick them into a higher tax bracket if it's income and not taxed like capital gains historically? That's not super clear in my reading of this document. The next thing to think about is that the prior proposal in this document is on the reform of the taxation of capital gains, right? So it says, look, long-term capital gains, qualified dividends are taxed at the highest at 23.8%, right? They're already saying 25 in the other, but here they're actually proposing, if I scroll down, that for anybody with taxable income of more than $1 million, long-term capital gains and qualified dividends would be taxed at ordinary rates, with 37% generally being the highest rate, and you tack on an extra 3.8% for high-income people due to the net investment income tax. And so with this, it kind of seems like this 25% rule wouldn't actually be the rule. It would be more like 40.8% for the people that are affected by this law, which is kind of crazy, again, from a historic context where capital gains were taxed at about 23-24% at the highest level. So not only would this rule redefine historically unrealized non-income as income, it would also crank up the rate close to 20% on those dollars. So whenever you read people writing articles freaking out about this, it's because that is a massive change in tax treatment, right? It fundamentally changes how we view held assets and how we define income, and it would also potentially greatly increase those tax rates that apply to things that historically haven't been considered income at all. Now, to illustrate just how big of an impact this would have, look at the next sentence. It says, look, under this proposal, taxpayers could choose to pay the first year, because what's going to happen is during that first year that this law would go into effect, massive amounts of assets would be taxed. And I mean, you're talking about somebody with $100 million worth of net worth. Much of it may be considered unrealized capital gains. So that's going to generate a massive tax liability in that first year. And so they're saying in that first year, you can actually take 9 years to pay it off. That's how big the anticipated tax liabilities are going to be. Because who's going to be able to come up with potentially 40-something% of their asset value that they just incurred? Now, this kind of change in taxes would create so many problems that there's a few other things that have to be explained that they have to get into. So, like, number one, they have to deal with potential mass refunds, because if we're talking unrealized gains, you could also have the next year large amounts of unrealized losses because you just paid a bunch of money in, but then your stuff loses value. You're going to potentially have to pay big refunds on these things, because what happens if the next year the stock market crashes? You've got millions, if not billions of dollars of stock that have now lost tons of value, and it's unrealized. And so they've got to work that out. And it's basically a complicated system of now they have to handle refunds to people for unrealized losses. And so it's a real problem trying to fix some of these issues that this tax proposal creates. So let's start off with the very first problem in implementing this law, which is it affects taxpayers with wealth, difference obtained by subtracting liabilities from assets greater than $100 million. Well, who is that? I mean, imagine the arguments that are going to be made by people that are in the $80 to $125 million net wealth range. Furthermore, how do you even establish this number? Because this requires a measurement of the liabilities, which is not that hard because usually liabilities are a contract with a specified value, but more importantly, assets. And assets are not that easily valued. And this is where we got to start looking at the type of assets that really, really wealthy people tend to have. So if we go to the Federal Reserve, you can look at the distributional financial accounts, which is a distribution of wealth across different percentile groups. For most people in the median range, most of their wealth is held in their home. It's real estate. A considerable other amount will be in cars and things, or in pensions, retirement funds, and things like that. Well, it turns out that some of those things are easy to value, some aren't. Real estate is not that easy to value. I mean, what are we going to do? Are we going to go look up somebody's home on Zillow and take that value for granted? I mean, if anybody's ever bought or sold a house, you know that real estate values are subject to negotiation. But that's not even the biggest problem. As you see in this chart, rich people do not have the same mix of assets. Real estate for them is a much smaller portion. This is because how do you get to be worth $100 million? Well, they have substantial investments in corporate equities and mutual funds. Now, those are not going to be difficult to establish their value because they're going to be tradable securities with market values. But if you look at the private business and other categories, these are sizable. And I've seen numbers that estimate that 40% of their wealth is likely tied up in private companies. And those are going to be phenomenally difficult to establish their value, both for the government and for the individual who's filing their taxes. So, I mean, at minimum, you're going to have to get valuation assessments that are very costly. And then what happens whenever the IRS disagrees with you? Because you may put yourself in the category below 100 million where you wouldn't be subject to these taxes, and the IRS is probably going to try to put you above that line. And millions of dollars are going to be at stake. So this is going to turn into a lot of lawsuits at minimum. The next big problem is even mentioned in this proposal. Let's say that you're one of those people and you've got a whole bunch of your wealth tied into your company. That's actually why you are wealthy, because you started this business and the business is now worth a lot. Well, the government comes in and says, you started that thing from nothing. Now you owe tens of millions of dollars in taxes. How do you get that money to pay them when it's tied up in your business? Well, they say, look, a taxpayer could be treated as illiquid. So that means they're illiquid if their tradable assets held directly or indirectly make up less than 20% of their wealth, right? I mean, if it's all in real estate that maybe they live in, or if it's in their business, it's almost impossible to get money out of that easily. I mean, you can't do it. You can't just piece stuff up like that. It's not stock that you can go out on the market and sell. And so that means that, I mean, a lot of people are going to be in a place where they may have tax bills that it's impossible to pay without giving up their company. I mean, that's really strange. And so whenever you make this election, it allows you to defer these taxes. But again, all this means is that, I mean, they know that this is kind of an unrealistic tax because it's going to be hard for a lot of people to even pay this because unrealized gains are not realized. They don't actually have this money. They have the assets. And by forcing them to liquidate, that's just kind of nonsense. Now, allowing these deferrals, what do you think's going to happen? A lot of people are going to try to move their assets potentially into classes which could be considered illiquid because that allows them to defer these taxes, and that's going to have a lot of value. So I would speculate that in the long run, this type of rule would actually move really wealthy people to try to create companies that are held more privately rather than publicly because it may help considerably reduce their tax bills. Now let's move on to the third problem. Now let's say that we're looking at somebody who is fantastically wealthy and they are not illiquid. Now this is going to be your owners of major public corporations. Founders. Consider somebody like Larry Ellison, who is the founder of Oracle, and as of September 8th, according to Forbes, he's worth $175.2 billion. Now, the reason why he is worth so much is largely because he still owns about 40% of Oracle. Now, as of this past week, Oracle's worth almost $400 billion, and so, yeah, he's worth a lot of money, mostly because of the stock that he has in this company. Now, why does he have so much? Because he started the company. It's his company, essentially. And if we pull up the ownership for Oracle, you can see he is by far the largest insider owner. He has over 1.1 billion shares, right? So he is fantastically wealthy because of this company. Now imagine the tax bill that Larry Ellison's about to incur here. Again, we're talking about somebody whose net worth is something 150 to 175 billion dollars. The vast majority of it is held in this one company that he founded. Now, what sort of unrealized capital gain is he sitting on? Well, again, you can value his stock at current market value as like 160 billion. So that's the current value. Now, the only question is, what was his cost base? Well, if we pull up the Wikipedia, it says that he started this company back in the 70s, and it says he founded Software Development Laboratories, and this is the company that became Oracle, with 2 partners and an investment of $2,000. $1,200 was his. Now, over the years, I'm sure that there's probably some more contributions potentially that he's made, but I would say that it's likely that the vast majority of his wealth is pure unrealized capital gain. All right. And now if you're looking at minimum 25% of that, you're talking a $40 billion tax bill. It's also going to cost him 10% of the company. That's basically what he will have to liquidate. So again, you look at Oracle, it's worth close to $400 billion. If he has to sell $40 billion worth of stock, what do you think that's going to do to Oracle's stock? Because who's going to buy that stuff? And what happens to the control of the company when he loses 10% of his votes? That's a major shift, not only probably in the stock price and the liquidity of the stock on the market, it's also going to change the dynamics of the control of this company, which is his, all because he needs to pay this tax bill. Now, this is kind of the second thing where I would say you will probably see companies with founders who still have large control probably do different share classes, and they may split shares along votes so that they can sell shares that don't have votes to try to retain control of their companies. That's going to be a big deal for them. This is not unprecedented. Back in 2016, Under Armour did this, and they did a 2-for-1 stock split, and the votes went with one share, and the other share was left without votes. And that was so that their CEO could basically sell off some of his stake, get some money, but not lose control of the company. And of course, this went to court, but these sorts of things aren't usually viewed in the best light by other investors. But I would expect to see more of this kind of thing start to happen if this sort of tax goes into effect. And anytime you look up a list of like the richest people in the United States, most of these people have large amounts of stock that is sitting in an unrealized capital gain state because they are founders of huge companies. So like Elon Musk, Jeff Bezos, Warren Buffett, right? Larry Page, Bill Gates, Mark Zuckerberg, right? Michael Bloomberg. All of these people will have most of their wealth as unrealized gains, and they are going to have to pay massive, massive taxes due to this plan. Now, some of you may say, that's fine, eat the rich. But again, think about what will this mean whenever these people have to sell a huge chunk of their holdings. These are people that are the CEO of their companies. These represent major ownership stakes. They represent major chunks of these companies' stock. And so what happens to everybody else's retirement portfolios when all of these major companies that are hugely influential in our markets start taking dips because of the amount of selling pressure these people have to do in order to pay their tax bills? And again, that's the first one-time hit. Yes, they have 9 years to pay it, but I think the reason they're giving them 9 years to pay it is because what an absolute cluster this thing is whenever you see what would actually happen in the real world. It's going to have major price impact on all these companies. It's going to have an impact on the market. And that means it's going to impact everybody else who's sitting on 401ks, who's sitting on 403bs, where your pension assets are invested. All that stuff is going to take a hit. And it's going to massively change the dynamics of control for a lot of these companies. And so I think this is where we need to probably wrap it up, because I mean, this is a topic where I could just go on and on and on about all the issues and weirdness that something like this tax proposal creates. And so, you think about the problems establishing net worth because of the problems with valuing non-trading assets. You think about the problem of someone who has tremendous amounts of their net worth tied up in non-trading securities and liquidity issues that's going to have, and the rules that have to be created to work around those type of issues. And then you get into the problems of, once you create rules to alleviate the strain on these people who are illiquid, other people are going to take advantage of it and intentionally make themselves illiquid to start dodging some of these taxes. That may have impact on the types of companies that we see going public in the future, because people may be more hesitant to make their companies public, because once it's public, it's tradable, and then they might not be allowed to take this illiquidity position. And then finally, the massive amounts of taxes would require a lot of major stockholders to liquidate huge portions of various companies. That will likely have negative impact on everybody in the market. It will likely cause interest rates to increase, as they will be less likely to invest in bonds and likely will liquidate some of those positions, and less money in that market means higher rates for everybody else. And they are going to be more likely to do weird stock splits to try to retain control of their companies. And then the final thing that I would point out, as you look at this list of all these fantastically wealthy people, keep in mind, currently Congress has 535 voting members. Think about the amount of money in taxes that I've been talking about, and consider that you could make every single person in Congress wealthy enough to be subject to this tax for $53.5 billion. Do you think this is ever going to pass? I doubt it. All of these fantastically wealthy people have enough at stake that I don't think this is ever going to happen. Nor, frankly, do I think it should happen. I personally think it's a really stupid tax proposal. But anyway, I don't want to get too far into the philosophy of it, because this was mostly considering some of the economic ramifications. So, if you got any feedback, as always, feel free to leave a comment down below.